Alrighty, so you guys want to learn how to read level 2. So if you guys could kindly pull up your level 2s, and even if you want me to if you want to screenshot them and send them in the chat, I can gladly break down your guys's trades. Going from left to right, I have a massive level 2 pulled up. If you guys have my setup, it's in the bottom right hand corner. Now, going from the left, you see a lot of 4 or 5 letter, they almost look like ticker symbols, right? Those are exchanges. Notice the EX in the top left-hand corner. Every broker has to be listed on an exchange, or every stock has to be listed on an exchange. You have the NASDAQ, the NYSE, you have OTC, which means over-the-counter, which, you have the ARCA. Over-the-counter is a little interesting, and I can go into that, another time. Because there are commissions trading OTC stocks, but I rarely do that. Okay, so moving on to the next one is the bid. This is the highest buyer. Okay, so think about it like a auction. This person is the highest buyer willing to purchase this product or the share of this company. And then moving on from there, you also have the same exchanges, and then you have the ask. This is the lowest seller. This is like saying, you're on eBay and you're like, I don't want to take anything less than, I know this worth of this stock or this company, and I won't take anything less than, said amount. And then from there, you see the AS, which is the ask size. BS is bid size, not what you guys think. And what does the bid and the ask size mean? Well, that's the amount of shares that they as in the trader, wants to either buy or sell. Now, notice how they're kind of small numbers. Those numbers are in hundreds. So if I pull up the screenshot here, bada bing, bada boom, this was a screenshot I had trading yesterday. So you can see, I just shared it. On Forza, there was a 45,500 share order to buy at 871. This made it slingshot and break right through 875. And eventually, I believe it got halted going up, and I was in on it. So when I saw that order, I decided to size up a little bit. It gave me more confidence within the trade. And the kind of thing about the level 2 is you look at both sides. Okay, so you notice the left side outweighed the right side. We call that bullish sentiment, meaning it's more likely to continue to go up because there's more buyers outweighing the sellers, and vice versa on the other way. If that, you saw, 500 on the right side, and only 35 on the left side, that's called bearish sentiment, or it's more likely going to collapse. Now, these types of orders take several seconds to fill, more than likely, depending on the float or the shares outstanding of the stock. So you're going to start seeing this go from 450, 250, 150, 10, and then eventually 0 because their order will be filled. The reason I bring that up and making sure you want to see the order be filled is because you as a trader can lose a lot of money due to market manipulation. This is a real thing. So what happens here, and I've seen it before, and I think I've had videos of it happen, is someone will put a massive order on a low float, penny stock, not right at the bid level, but close. So like 867 in this example. So it's close to filling. And then right before it gets filled, they yank the order. So what that does is that brings the bid up. Usually I see it on both sides. And so eventually what that does is it kind of inflates the price, because retail traders see that order and like, I'm buying it. And they yank their order, and those people already bought. And they continue to do that to kind of help the bid price go up. Now, the ask price, it's kind of the same thing. So if someone wants to purchase a stock for a lot cheaper than what it is, you'll see, a massive sell order at say 889. And then right before it's about to get filled, they'll yank it. And so what that's going to happen is people are going to see that order and go, oh, yikes. I don't want that thing to get filled when I'm in on it. And then eventually they'll work their way down, and you'll probably see the order flip on the other side and buy. It's happened. Very annoying. Does not happen much, but it does happen. So I like to see the orders start to get filled and then kind of add into the move before I really get super excited about any big orders. Like I said, the low float stocks we're trading, you're going to probably start to see those orders be filled before actually the entire order goes through. And then the slippage, a lot of you guys have asked, so what's slippage and why is it so important? Slippage can make or break traders, literally. If you're on a paper trading account, there's quite literally no slippage, guaranteed fill, and slight delay. And you notice you make a lot more money off of paper trading. And you're like, man, I wish I could switch this to live trading. Or you see these gurus brag about some gains. And slippage means if you are buying and selling market, you are going to be filled at the, generally speaking, the worst price possible. Because by saying, okay, hey market, I want to buy using the market order, you're letting the the market makers kind of fill you at the worst level possible. So generally, if you're buying, you're going to be filled in the ask, and if you're selling, you're going to be filled in the bid. And the reason why it's so important, and the reason why I watch it so much, is because if there's a gigantic slippage, and I know already I'm going to lose a few $100s by simply buying the stock, it has to be a super high conviction trade for me to want it, man. For example, WETG was halted going up and then resumed. The ask, the lowest seller was at $8.50, and the highest buyer was at $8. I'm not going to trade that. Almost 10% slippage is ridiculous. So I would already be down half a dollar share by purchasing that stock. And if that stock corrects even a little bit, I'd be down 75 cents a dollar share, and I could lose $2-3 grand very, very easily. So slippage is very important. Something you want to note. And again, the slippage is the difference between the bid price and the ask price. In the screenshot I'm going over, the slippage is only 4 cents. So you're going to lose probably 4 cents in the buy and 4 cents in the sell, and you just have to be okay with that. And that's that. Now, the reason that the slippage gets greater is because certain market makers that buy the shares from you and then sell them back to the open market. For example, if you look at the slippage of drug right now, it's anywhere from a 5 to a 7 cent a share slippage. Now, if you go to Bank of America, it's going to have a 1 cent slippage. The reason why Bank of America and all the large cap stocks slippage is so much smaller than the penny stocks that we trade is due to market makers have to understand the risk of being a market maker for that stock. Okay. And market makers are, I don't know if you guys are familiar with crypto, but it reminds me a lot of liquidity pools. Okay. Kind of providing liquidity to the market by buying shares from someone and then selling them right back in the open market almost instantly. And they get a small piece of that pie. By providing liquidity, you get paid. So in the crypto realm, by adding your money into the liquidity pool, and when someone uses that, you get a certain percent, of the gains. So it's kind of the same thing in my head and how I think about it. And the market makers have to analyze the risk, with these stocks. There's a lot of competition to be a market maker for Bank of America, for Tesla, for Apple, for all these, stocks, because there's so many makers that like to do it because it's least risky as possible. You wouldn't see, Apple flush down and get halted going down, at an instant. Oh, I hope not. Now on drug, that can happen. On BWV, that can happen. On all these other stocks, that can happen. And the thing about it is, the reason why the slippage is greater is because they have to understand the risk to reward of trading it. Basically, they're saying, okay, I'm willing to provide liquidity, but I want to make a little bit more money per share, and that's totally fine. And that's what creates, greater slippage. I just shared, an example in here. And so there's 3 main colors, okay? There's the green, there's the red, there's the yellow. Now, mine may look a little different than yours because, I'm using the old style thinkorswim because I'm weird like that. But the red means that the order was on the bid or on the lower end, closer to the bid. So if you have decent slippage, generally you're gonna find red is on the bid side more than likely, and green is gonna be on the ask side more than likely, because green means they push their order up kind of closer to the ask. So the way I look at it, if you find a lot of reds, in one area, then what that's kind of saying is they want to generally sell out very quickly. Like they want to be out. Okay. And if it's green more, so notice that most of the level 2 in this area is green. That shows that people want to be filled right now. Like they want to be filled on the ask. They don't care. They want to get in. And yellow means they're more than likely not going to get filled. It is outside of the bid ask range. This could be yellow, this could be gray, this could be white, depending on what platform you trade on. And all that's stating is, they're just kind of hoping and praying. They're not really, like pushing to get filled either way. So if it's a lot of red, that's more of a bearish sentiment. If it's a lot of green, it's more of a bullish sentiment. So the colors can help a lot, in a certain area. For example, if the colors are red on both sides, people want to get out. If the colors are green on both sides, that's very good. Very good for the stock.